It's an earnings-heavy day today. So let's straight take you through the earnings corner. India's second largest private sector lender, HDFC Bank, came out with its first quarter numbers today, reporting a largely in-line set of numbers. On the NII front, HDFC saw a 21.8% rise quarter on quarter, beating street estimates, and net profit, which came in at 20% higher quarter on quarter, missed the street estimate by a whisker. Now, there was a slight hiccup on the asset quality front, but that remains largely under control. And let's take it straight to my colleague Ritu Singh, who was right there at the HDFC Bank's AGM being held at the Birla Mathushri, and sent us these key takeaways.
Straight to the key highlights of HDFC Bank's first quarter performance. Number one, profit growth. Gone are the days of the 30% consistent growth in profits, and 20% seems to be the new normal for HDFC Bank, which is exactly what it clocked in this quarter also, supported by a good growth in net interest income and other income. Number two, its core fees, which is reflected in the net interest income, that grew by 21.8%, supported by a growth in its assets base, which grew by over 20% in the first quarter. Number three, asset quality. That has been a pain point for most of the banks in the system, but not for HDFC Bank, with gross NPAs at 1.04% and net NPAs at 0.32%. Yes, a marginal uptick from the previous quarter, but that was mostly on account of a surge in bad loans in the SME and the business banking segment. But the bank still maintains one of the lowest NPA levels across the entire banking system. Number four is provisions, which have jumped over 30% compared to the previous quarter, but that's mostly on account of the provisions that the bank had to make for its exposure to the Punjab food grain program at 120 crores spread over Q4 and Q1. Advances growth was also very strong for the bank at 23%, led by both a growth in retail as well as wholesale. And lastly, the margins, which stood at a very strong 4.4% in this quarter, and the bank says it will be able to maintain it at more or less the similar levels through this year.
I've traditionally said that, we don't have a guidance on any one number for a quarter or for a year, but if I look at the historical range, we've been for the longest time between, around 4% to about 4.3. In a sense, perhaps this quarter's 4.4 is, sort of bursting the upper end of that range. Some of that has come from the gradual change in mix which we've had between wholesale and retail. As you're all aware, as retail as a component or as a proportion of the total loan book increases, the yield is slightly higher, and that helps the net interest margin.
And also, HDFC Bank's MD Aditya Puri doesn't look too worried about the bank's NPAs. Of course, it doesn't have too much corporate leverage, and he spoke to media on the sidelines of the annual general meeting of that bank today.
We have gross NPAs of 1% and net NPAs of 0.3. A little movement here or there, 2-3 basis points if we keep worrying about, and it cannot be based on steel exposure, then there would have been a major jump.
And on a separate note, when asked about the next RBI governor, Puri said that there are enough credible contenders for that top position at RBI, and the issue must not be personalized.
Next governor will be brilliant as well. Always our governors have been brilliant. Don't personalize the issue. There are enough people here to give you a brilliant governor.